What's up guys, Ben here and welcome to Motivation to Invest. When the planet went into lockdown, video streaming services such as Netflix saw a huge boost in popularity. Netflix actually ended the second quarter with nearly 193 million subscribers, up 10 million subscribers from the previous quarter. This is incredible and means a lot of people must have been Netflix and chilling. However, now Netflix faces increasing competition from rivals such as Disney Plus, and many question whether its high valuation is justified. Of Netflix's 193 million subscribers, 73 million or 38% are in the US and Canada. Now this leads to an interesting question. Aren't we forgetting the elephant in the room? I'm talking about the country with the world's largest population of over 140 billion people. The country with the second largest economy on the planet, and the country with a growing middle class population. Of course I'm talking about China. As many of you guys will know from my previous videos, China actually restricts many of the large US tech giants from operating in their borders. For example, in China, there is no Google, Amazon, or Netflix, but there is Chinese equivalents of these companies. So in this video, I'm going to deep dive into the Chinese version of Netflix called IQiyi. It's currently going for a bit of a scandal, thus has a low valuation. So could this be a great buy right now? Well, in this video, we're going to find out. Let's dive in. Welcome back guys to Motivation to Invest. Before we get started, it would really mean a lot to me if you guys can give this video a big thumbs up. That really helps out with the YouTube algorithm, which allows me to create more great content like this for you guys. In addition, if you want more investing tips and exclusive stock picks, which I personally am investing into, then you should definitely subscribe to this channel and turn that notification bell on. With that being said, let's get into the video. So the Netflix of China, IQiyi, is the market leader for video streaming in China with over 110 million subscribers. The average sales growth for the past 3 years is nearly 40%, making it a true growth company. However, revenue growth did slow this last quarter, which surprised many as Netflix in the US boomed. This is due to a major difference between IQiyi and Netflix. IQiyi uses a very different freemium business model in that it offers its original content upfront for free and then runs ads and charges some of its members a subscription fee. This is a key discrepancy, with around 50% of their revenue coming from advertising. When their advertising was hit during the 2020 market crash, so was their revenue. To diversify, IQiyi is looking to expand to Southeast Asia. It also has a content distribution business which grew 68% year over year. But other revenue, including its online games and live broadcasting, saw a decrease of 21%. However, there is a major challenge for the Netflix of China. The company is just not profitable. But there is a good reason for this, as they reinvest all their cash into new original content and running their platform. This may pay off in the long run, but in the short term, it's very risky for investors. The Chinese giant Baidu, which many call the Google of China, as it is the #1 for internet search in China, has a 56% stake in the Netflix of China. However, that's not helped the company, as it's recently been hit by fraud allegations by short sellers who claim the company is inflating their revenues.
Shares of Chinese streaming giant IQiyi tanking after the company confirmed the SEC is looking into fraud allegations. The investigation comes months after Wolfpack Research published a report accusing IQiyi of inflating its revenue numbers. IQiyi is often referred to as the Netflix of China. And by the way, Baidu owns a majority stake in this company. Baidu shares were under pressure as well.
These allegations saw the stock plummet, and Baidu is launching its own internal investigation. So the question you guys need to ask yourself is this a great opportunity for a contrarian investor, or is it just too risky? Well, I'll answer this question myself by telling you whether I personally have purchased shares in the stock. Well, As you guys will know, if you watch this channel regularly, you'll know that I'm very transparent about the stocks I buy and even sometimes when I buy them. So if you guys appreciate me revealing my investments to you guys, then feel free to give this video a big thumbs up. That really helps out with the channel. So did I buy shares in this stock? Well, no, not this time. I've avoided this stock as to me it's just too risky, it's unprofitable, and there's a lot of allegations going on with regards to fraud on the revenue. I don't need that kind of stress in my life. However, I do own a stake in its parent company, Baidu, which is much more diversified and a safer bet. But are there any other alternatives to get involved in the massive video streaming market in China? Well, there is one really special one I've been looking at, and it's called Huya. This is the market leader in esports and live streaming in China. Its streaming platform is popular for broadcasting esports events, and China is about to surpass South Korea to become the second largest esports market in the world, just behind the US. Esports is an emerging channel of growth in the video game industry, and Huya is an excellent stock to ride that trend. Unlike IQiyi, Huya is not dependent on a healthy ad spending to grow revenue, as ad revenue for this company only makes up 4.7% of its business. Most of Huya's revenue is actually generated by its users purchasing virtual gifts for their favorite streaming personalities. This just shows you how different the culture is in China compared to the West. Live streaming revenue increased 77% year over year and comprised of 95% of Huya's business. Huya is growing much faster than IQiyi, and this growth seems more robust and long term. Because of China's enormous gaming population, there were 687 million gamers in China in 2018, and that's expected to increase to 891 million by 2023. Huya's main costs are bandwidth costs to support its live streaming and revenue sharing fees with people who stream the content. But these costs are nowhere near to IQiyi's massive costs to produce its own original movies and TV. So to me, Huya is a fantastic growth company. But remember guys, this is not financial advice. Investing is risky, especially investing into Chinese stocks. So don't invest any money which you can't afford to lose. So which is your favorite growth stock right now? Comment your thoughts below and I'll join in the discussion. Also, be sure to check out my previous video on the number 1 Chinese growth stock I may have bought shares in. I'll leave links for that video above and below. That video is a must watch, guys. Also, I have a very special treat for you guys. So as you guys know, to invest in stocks, I use the free trading platforms, Trading212 and Stake. So if you guys would like a free share with up to £200 or $200 for any one of those apps, or both of those apps, then you should definitely use my special links below. When you deposit, you'll get your free share. Now, this is a limited time offer, and I know many of these free trading platforms are actually stopping this service as they're already so popular. So sign up, use the links below, collect your free share, and have a Merry Christmas. In addition, if you guys enjoyed this video, I would really appreciate it if you give it a big thumbs up. That really helps out with the YouTube algorithm, which allows me to create more great content like this for you guys. In addition, if you want more investing tips and exclusive stock market picks, which I personally am investing into, then you should definitely subscribe to this channel and turn that notification bell on. With that being said, I'll see you guys in the next video. Invest safe.